All right, we'd like to welcome everybody to Fluent Financial's June 2021 webinar, and we're going to be covering a lot of the same information we cover each month. We're going to talk a little bit about inflation, some interesting kind of good news on the COVID front, and it's just kind of interesting how the science is the same, but the politics have not, or the politics have changed, I should say. Joining me on the call today is going to be Mike, and this will be one of our more shorter webinars. We expect this to be less than 30 minutes. We will have a Q&A session at the end, and we will turn on everybody's mics at that time and turn off the recording. So we'll go ahead and get started. And Mike, why don't you talk to a little bit about your weekly update you do?
Okay, thanks, Mitch. Hi, everyone. So every Monday morning, I try to do a recording of what we saw in the markets the past week and what we expect to see in the week ahead. So it's just a quick what you should know, something to play in the background if you want to just check in on the markets. I know most of you don't sit and stare at the markets like Trey, Mitch, and I do most of the day. So some of you may find it as a useful tool. Mitch, we also have the YouTube channel, is that correct?
That is correct.
And what do they need to do to access that YouTube channel?
Yeah, when you can either go to YouTube itself and type in fluentfinancial.com, and you can find our prior webinars we've done in the past. You can also, on your Orion page, there's an update on the top bar. You can click on it, and it will have our webinars as well as our newsletter. And what we've been doing recently is taking these webinars and condensing it to a short read that we just kind of hit the top pages. So it's good information. A lot of people subscribe to it. I know Mike has, I guess a few hundred people that look at it every week. So it just gets some good information. So the next thing I want to talk about, we'll get the COVID stuff out of the way pretty quickly. The bottom line is it's very good news. I mean, you can see all the numbers here have plummeted. No big surprise. We had been telling people by the second quarter, by the end of the second quarter, COVID may be in a rearview mirror, and that appears to be what's happening. And there's a couple reasons for that. I think one of it is herd immunity from people that have had it, but the other big part of it is the vaccinations. It's total of U.S. population with one dose, and now is over 70%. And there's probably a large number of people who had the disease that were asymptomatic. One thing I want to share with you guys, and this is from our May 2020 slide, was this slide here. And this slide's highly technical, but all I want to share with you or have you focus on is we were told that the virus did not come from a lab, and mainstream media basically kind of beat that into our heads last year. But Nature did an article last spring in March, and they had this diagram. And really all I want you to focus on is this big white space here. And there's these letters PRRA, and you'll notice that these letters do not exist in the horseshoe bat, the pangolin, SARS-CoV-1, and then these other bat coronaviruses. And the reason why they don't exist, they weren't inserted. And this article went in to say that, well, it doesn't look like the lab did this. Maybe they could have. And one of the authors of this article recently just deleted his Twitter account. And my brother, who I've talked about in the past, works in this area, and he said this was definitely a man-made insertion. And you may see this in the media, but we were talking about this over a year ago. And I think you're going to see more truths come out about coronavirus. It's just sad millions of people died. Our world has changed. Our country has changed. And is it really for the better or not? A lot of people do not think so. So that's all we're going to say on the coronavirus. It's great to get back to normal. We're seeing clients in office. People aren't having to wear masks if they don't want to. So I'm going to turn this is the end of the COVID part. So I'm going to turn this over to Mike and talk a bit more about what's going on in the markets.
Thanks, Mitch. For those of you that have tuned in the past, we put this up. This is what has happened in the markets before. So it was pre-COVID high versus where we are now. And I think a point to be made here is that if you would have fallen asleep or gone abroad for 6 months, you might not know that there was a crisis in the world. So again, it's very hard to time the market. We encourage people to stay invested and invest based on your risk parameters. And I think things will work out well for you. We have some key insights here for today's meeting that I'd like to talk about. Concerns about inflation seem to be a bit overblown. The near-term spike in inflation is likely temporary. Value versus growth. We tend to be more of a value shop, but we do have growth stocks in our portfolio. When I say value versus growth, think of a value stock like a Walmart that pays a consistent dividend over the years versus a growth like an Amazon that does not pay a dividend, but is growing by leaps and bounds. So a key to that is selectivity. Now, that being said, the Federal Reserve came out yesterday and moved up some of their anticipation of raising rates and things like that, basically reducing stimulus. They had a couple of key points yesterday. The Fed moved its projected rate hike from 2024 to 2023. So that spooked some markets today. We saw some commodity prices drop across the markets, and they are lifting their projected inflation rate from around 2.5% to 3.5%. And the Fed said they'd be willing to run inflation a little hotter than normal. And so we'll see. This is going to be a good test to see if they're willing to do that or if they're going to panic and start moving rates higher. So that's what we're going to talk about today.
Okay. And I think what's been interesting is as people are more comfortable in going out there, resuming their lives, and people are spending a lot more money. And what you'll see on this chart here is the open table reservations are basically at the level pre-pandemic, and air travel really since February has had a pretty significant spike upwards. I know American is going to be asking some of their people to work in the office to come to the airport to help out some of the people with the passengers. I don't know how well that's going to go, but if you've been on planes and been flying, they're packed. I know I've been on planes a couple different trips in the last month or so, and the planes are totally full. So that's not totally unexpected, but people are going out. I think the other point that's important is people are saving 21% of their disposable income in the first quarter. And I think it's a combination of people not wanting to get out because of COVID, and then secondarily because what's happened, a lot of the baby boomers may be behind on savings. They have to recognize they got to save some money for a rainy day. So I think that's been really, really important.
I want to add something to that, Mitch. Chicago, New York, and the big cities in California aren't participating in this chart right here. They're just now starting to reopen. So there's a lot of the country, a lot of big markets that are not participating. So I feel like we're about to take off.
Yes. And part of that is we're going to have this pretty significant demand outpacing supply, and it is causing some of this temporary inflation, but we do think it's temporary. So Mike, why don't you elaborate?
Yeah, so this is the red chart. The red lines on here is CPI, which is the Consumer Pricing Index, which is what the Fed uses to track inflation. And the left oval is what we saw coming out of the 08-09 financial crisis. And your right oval is what we're seeing now. And what happens is so you have a bottleneck in supply, and demand starts to spike, and then supply has to catch up. So it's perfectly natural to see some of these inflationary spikes. The Fed says that they are temporary. I think there is some truth to that, and that is not something to currently panic about as the supply chases demand going into this summer.
Yeah, and if we look at this over a much longer period of time, if you look at the past 100 years, it puts it in very good perspective. So if you want to go ahead and kind of talk to the group about what they're looking at, Mike.
So here's the headline you're going to see. The headline is going to be, inflation levels see their sharpest jump since 2009, with exclamation points. Okay, well, the little oval there where Mitch is highlighting is 2009, and then look at the oval for 2021. But look at where we are since the 70s and 80s as far as inflation. We've been on a downhill slope. This is just a chart that says, hey, look at where we've been over 100 years, put things into perspective. I think it makes headlines, but I think the professionals have been looking for inflation for the last 2 decades, that hasn't really reared its head. I think a lot of that could be attributed to increases in productivity from technology. And I think we're going to see more of that in the next 20 years.
Yep. One thing I think it's important to mention is we are not saying there will not be inflation and our government can't continue to print money like it has. In a webinar a couple months ago, we showed a slide where 50% of every dollar the government spends is being borrowed. And not too long ago, that number was 19. So they are sowing seeds for longer term inflationary problems. And we have to see how long this will continue and if the Fed will take action sooner versus later. And Mike, why don't you go ahead? There was a report that just came out prior to our webinar. Why don't you kind of tell the group what the Fed was saying?
Yeah, well, I kind of covered at the beginning, but the Fed came out with their notes yesterday, and they were talking about what I said before. They're moving their projected rate hike. They were anticipating in 2024. They said, okay, now let's do it in 2023. They expressed concern in the jump in commodity prices. And then just today, commodities really got hit pretty hard. So the day after his concerns, Jerome Powell stated that he was surprised at the speedy recovery in the U.S. economy, and that, again, they lifted their inflation projection rate to 3.5% from 2.5%. To put that in perspective, the Fed typically targets 2%.
Yes. And a little more at a micro level, we're saying that used cars and trucks are making up 1/3 of the inflation bump. And a big part of this has to do with the shutdowns last year. And you have rental cars or people buying cars on a somewhat regular basis, but there was really not a lot of cars manufactured last year. And now that people are opening back up, there's a shortage. That's why you're seeing, record prices being paid for used cars and trucks. And part of the transportation, the airline is part of it as well. So you've got this temporary inflation spike. Also, the oil gains with rising inflation is also it's kind of boosting the appeal of commodities. So this next chart here, Mike, why don't you go into a little more detail about what this chart is showing us?
Yeah. So if we focus on the top two blue areas there, we see that the goal of the Fed, what I just talked about, is a 2% target inflation, and our average is above that. Right now it says 3.6 here. I think the Fed is anticipating 3.5%. But this shows that it is running, the economy is running a little bit hot right now. But again, we don't expect that to be sustained longer term. And then, Mitch, you want to talk about the bottom section here, about room to grow?
Yeah, I think part of the problem we have, Mike, and thanks for that commentary. We have a lot of people that are not working, and part of the reason why is they're getting paid by the government not to work, and we now have over half the states in the country are refusing the federal subsidy of keeping people not working because they're just watching TV or doing whatever. And it's killing the small businesses, especially in the hospitality area. So if you look at the U.S. employment rate pre-pandemic, it was 3.5. The goal is keep it under 4. We're at 5.8. The underemployment rate is out of whack. Labor force participation rate is lower. Employee population ratio, it's lower. All these numbers are driven a lot by the federal government paying people not to work. And as those dollars dry up, people are going to go back to work, so this should improve. And while we're on the subject of job openings, we have got a record number of job openings. Like 9.2 million. The government benefits, as we talked about, are hurting us. This American Rescue Plan and another federal government handout, paying another $300 to September. It's ridiculous. It's not needed now. It's causing more problems than it's solving. And if you look at the great financial crisis here, you can see this big drop, and then people went back to work, and you have this big drop here, and then you can see here these openings. And again, we have said this in the past. The biggest problem prior to the pandemic for most businesses, couldn't find enough qualified people to do the job. Well, that problem did not go away because of COVID. It's probably been accentuated because we still have 10,000 people a day turning 65. And those of you that are on a call that are still working, you know exactly what I'm talking about. It's a huge problem. And we mentioned earlier that half the states have decided to suspend taking this $300 per week supplemental employment benefit from the government. And there's just some funny cartoons. You guys can read through these. But
It's a stat that I saw this morning. They said that there's 9 million people unemployed and there's 9 million jobs.
Yeah.
So I think if you want to work now, that you might be underemployed, but if you want to work right now, there are jobs available.
Yep. And something else, and this is, Mike had talked about this in August last year, and this is our slide from August about what we'd expect would happen by now, and sure enough, it has.
Yeah, so that bottom left chart there, Mitch, on the bottom right, that bottom left chart cuts off where the bottom right has that red line going up and down in the middle of it. Yeah, so everything to the left of that red line is what you see in that chart on the left. Yeah, and so what we were saying back then is, we were definitely feeling some pain from the market back last August. We had not had the vaccine announcements yet. That happened in November and really started the broad market recovery. But we said children would return to school, and we see that happening. That'll happen more so coming into this fall. On election results, now that we know what's happening, we see that. A vaccine should be approved. We didn't know when that was going to happen. That has occurred. And I said a big thing, the June 1st travel season will release that pent-up demand. Mitch just talked about people with 21% savings rate when pretty much nobody saves, or a 3% savings rate is high. I don't think people saw the light. I think that money is burning a hole in people's pockets, and that demand will be unleashed this summer. If anybody's been on a flight lately, they know how packed those flights are. And you're going to see oil demand coming back online. Europe is opening back up. China, it has increasing demand for oil. So again, we just wanted you guys to know that these things that we said, you don't really know when it's going to happen, but you kind of put some common sense together. And June 1st was really that opening date. And now we're seeing people, the U.S. is open.
Great. And part of the money is, and we referenced this slide last month, we just have a record amount of money market fund assets. This is 4.8 trillion a little over a year ago. April this year, it's 4.5, so only 300 billion has come off the sidelines. And if you look at where people invested their money 1 year after the decline, this is the .com 1 year later, and this is the housing crisis. And I think what's really interesting is even after the .com market, people still like the stock market. That's the orange color here, 202 billion. But after the housing crisis, because we've been saying for years the bond market is basically dead. So after the housing crisis, most people put their money into bonds versus the stock market, because back then they were getting like a 2% yield. Now you can't really put money in bonds, and the stock market's really the only place. And we shared this slide a couple months ago, and this is your traditional 60-40 portfolio. We have 60% in equities, 40% in bonds. Long-term average is 6.22. Today it's 3.21. How many of you, if you had $1 million and you're getting 3.21% yield, that's $32,100 a year. You can't live on that. At least most people can't. And you would try to add a little humor with the dead T-Rex. JP Morgan wouldn't do that. Probably wouldn't pass their.
Mitch, can you go back one slide for me?
Sure.
I just wanted to add something. So typically we buy put protection to put on the portfolio. If you look on the left-hand side here, this record money sitting on the sidelines, that money is looking for yield. That money is looking for somewhere to go. So when we think about, could there be a 5% pullback? Could there be a 10%, 20% pullback in the market? That money that's been missing out on the latest rally, I feel like is going to put a glass floor underneath a lot of the equity investments and come rushing in and really support this market on any sort of pullbacks. So when we talk about buying any dips in the market, I think that money right there, a lot of that money will be put to that use. And so I'm not really scared of some big decline in the markets here in the next 18 months.
Thanks, Mike. All right. And why don't you talk a little bit about the value stocks?
Yeah, so we typically do, so we like to invest in value stocks. The theory is our clients have already made their money. My job is to keep that money. I don't need to hit a 1,000% biotech return on some new drug. And so that's typically where we lie. And in this 2020 FANG rally with all these growth companies rallying, we definitely trailed the markets on that. But then once the vaccine was announced, you saw a boom in a lot of your value stocks, a lot of your dividend paying stocks, as that rally became more of a broad market rally. And what you saw is a big run up here early 2021 in value stocks versus growth stocks. So we've definitely benefited from that, and our portfolios are outperforming the market overall by over 5%, our equity portfolio. And then it remains to be seen what happens the rest of the year. But this can taper out for the remaining part of the year. We still don't know, obviously, what's going to happen with the rest of 2021.
Okay. And something else that we're seeing, with the new administration, they are obviously very pro-green, and climate change is the biggest threat to our country. I guess they ignore China, but that's a topic for another day. But even if, the Western oil majors, they have very little presence in China, India, and Russia, and a 10% reduction in China's emission would cut the volume of carbon dioxide in the atmosphere almost as much as halting it completely in UK, Italy, and France. And you can just see here in this chart on the right how much pollution China is creating, and you can see U.S., India, and Russia. And this next slide that we talked about this in April, you can just see the amount of CO2 emissions that China is polluting. And again, we have a low degree of confidence that China will be able to reduce their carbon footprint. And again, one of the China's exports is coal-fired plants in Africa, but no one in our country wants to talk about China's pollution, and I just wonder why.
I think it's highly unlikely that China will give up a competitive edge as they race to try to take over the world just so they can reduce some carbon emissions.
Yeah. And let's talk a little bit more about the oil prices and the U.S. economy, Mike.
Yeah, okay. So in this chart here, you see oil prices on the top and real GDP on the bottom is our productivity as a nation. And the oil demand is going to continue to strengthen is what our theme is, and in China in particular. And there's going to be a little bit of a catch-up that's going to have to occur because American producers are still waiting to ramp up production. The Saudis, OPEC Plus, they're talking about increasing production, but believe me, they like higher prices. These are countries that rely 70+% of their budgets on the price of oil being of $75 plus oil. So for a run up in oil to happen right now to 100, I don't think is a crazy expectation as supply chases that. But at some point that'll even out. But we should expect to see some higher oil and commodity prices related to oil going forward in the short term.
Yeah, and I think part of the problem is in terms of the supply, the Biden administration has basically put a moratorium on drilling on federal land, so that those particular markets, whether it's the Gulf of Mexico or Anwar in Alaska, the oil companies can't drill. So the people that have private land, they're seeing an increase in drilling going on. But the sad commentary is in order to be green, because that is the appropriate political correct behavior, guess who's paying the price for that? The poor and the middle class, because when you fill up your car in your poor middle class, that is a direct tax on you. For the wealthy, it doesn't move the needle. But it's the people that our government's allegedly taking care of, they're actually being penalized by the political correctness and pushing a green agenda, while China continues to pollute unabated. No one will call them to task. So it's and most people on this call know that, but it's just what we're seeing is bad. But how does this impact you? And it goes to our portfolios, which is on this next page. And Mike will talk about this in a minute. But our V&O portfolio at the high water mark, it was 30% energy. Now it's 20. We've talked about reducing it further, but based on what we're seeing in the last couple of slides, we're going to probably be overweight in energy for the time being, because we see that Europe is still not fully online. California, New York are just opening up, Michigan, Illinois. So as these states come online, we still think there's going to be room to grow in the energy sector.
Yeah, and I just made a couple of highlights on here that shows the top highlights are going to be your S&P 500, and your bottom is our 100% equity portfolio, no options associated with it. And you see in that fourth quarter, we had that November 9th announcement that a vaccine was going to occur. And that really started benefiting our value positions that we were taking. And you notice in Q1 of this year, we outperformed the S&P by around 10%. Yeah, actually over 10%. And then in Q2, it started pulling back a little bit, but we're still a healthy way ahead of the S&P. And a lot of that's those value positions and our oil stocks, our energy stocks.
Yeah, and more specifically, if we look at a large number of the shares in the V&O and the ADVP portfolio, half of that portfolio are these stocks. And we won't go through all of them, but some of the changes we made, we added New Core, we added this S&P Global Fund, we added Visa and McDonald's as kind of a rotation to more of a Biden-friendly portfolio. Intuit's another one that we added, and those stocks have done well and held the portfolio up. But I think probably the biggest advantage you guys have realized is our income generation from our options-heavy portfolios. And this next slide here basically shows that our three heavy options portfolio, ADV, ADVP, and stock income, and this target here is what we expect they will generate in the cash, assuming $1 million portfolio. This is what they've actually have done, and this is the amount of money they would generate on an annual basis. I know some clients don't have enough assets to put in one portfolio being stock income, but you could be an Advantage or Advantage Plus, because Advantage you're at about 200, Advantage Plus is about 350, 380. And you can get this kind of income stream if you need it. And this has been a differentiating factor. We've been doing these strategies. Stock income has been around for 26 years. We've had it for about almost 2 years here. These others have been around for over 8 years. So it's a differentiating factor. It allows people to retire sooner, have a better lifestyle.
And Mitch, we are already, if you take the first 6 months of this year, we're already 62% of the way on our target, 50% through the year for stock income.
Yeah, that's great. So now that kind of completes our webinar. So if anybody has any questions, I'm going to stop the recording.